the situation in the banks, the improvement for earnings is one thing, but the optimism, it seems, is already in the price. So which one is overbaked right now? Are we going to get the improvement, or is it already priced in?
Well, I think it's probably a bit of both if you look through. You know, the financial sector is no different than a lot of the other sectors that are out there. You know, the reality of what's going on with earnings versus the optimism that as far as what's happening in the markets is creating some scenarios that are, you know, pretty risky and a little bit unsustainable in our minds as far as how investors should think about it. The financial sector, as you say, has been pretty beaten up. It's a sector that we have, you know, typically not had a lot of exposure to within the Jensen Quality Growth Fund, but that isn't necessarily a mark against the financial sector as much as it's just something about how those companies don't necessarily meet our qualification standards for consistency in their revenues and earnings. And you were mentioning that, you know, that maybe this is the time for financials. If it is, that, you know, certainly could help the economy, but we'll just have to see.
Peter, optimism about earnings, and then this story, and I say it's a story because I don't see it in the price, this story of a steeper yield curve. I see one that's rolled over the last month. Are we really going to get that steeper curve that's going to support these valuations?
I don't see that. I look at what Mike said and what was just said is like, you know, the definition of an economist is someone that sees something that works in reality and questions whether or not it will work in theory. And right now, I like to listen to reality and not theory. So the reality is the yield curve has not gotten steeper. The markets, and you look at JP Morgan, markets are a discounting factor.
Which hits a record high again.
Yes,
once again this morning.
If it anticipates the fact of everything that Mike said, which is true, then that doesn't mean it's a buy. You saying, well, it's been flat. JP Morgan was at 20 when Dodd-Frank was passed. Now it's at 91. If I'm sitting at JP as an employee, God, I'm terrible. I hate Dodd-Frank. Wow, that's the worst thing that ever happened to me. Come on. So now I'm going to unwind it? That's why I say question, look at reality, don't look at theory.
Well, I think that the reality that Mike Mayo, though, would make is that you can't value these banks now on today's numbers and how you value them in the last 8 years. You have to value them on how you value them, say, 15 or 20 years ago. If we get that rollback in regulation, if they don't have to increase their capital costs, what's the counter argument to that? Because he says you can see a 50% increase.
So I always like to say, if you take 22 guys and you put them on a football field and there are no referees, they're going to kill each other. When we had unbridled competition without regulation in these markets, they all rolled up their sleeves and they took more and more risk, and the end is bad. If we unwind all that, we're going to have a similar ending.
As an investor, you're not thinking about what happened, you're thinking about what's going to happen as best you can.
Yes.
Does the strength of the financials that we've seen since the election give you some encouragement about where the overall economy is going? Because a strong financial sector tends to indicate we're going to have a stronger economic sector.
Not particularly, because they've already made their big move. And look where we've come from an economy off of the '09 lows. We've had record months in a row of employment. Inflation's been low. The consumer's much better. The financial situation in terms of debt on individuals is better. You know, and then there's creaking warning signs, whether it's subprime auto. Again, you look at that, that's an area where it's leaking. You look at student debt. So there's starting to be these signs. That's why we talk about this inflection point.
Yeah, you look at financials this morning, then JP Morgan at an all-time high once again. Bank of America on pace to close at a 2008 high. The financials full stop on the S&P. If we closed right here, it would be the highest since 2007. That is where the optimism is, Eric. Where it hasn't been is healthcare. There has been this discount applied to the healthcare sector because the president sits in front of the pharma CEOs and says, get your prices down. Are you bullish healthcare, and give me the why?
Well, we are still bullish in places where we think healthcare can function without sort of price risk, if you will. And you mentioned pharmaceuticals. You know, in places where there's still, you know, good market dominance, there are areas where there's going to be continued consumption of healthcare. So, you know, a company we would look at in one of our holdings is Becton Dickinson, making needles and syringes globally. It's sort of a first line of defense in terms of how people begin to consume healthcare, particularly in emerging markets. And it's less costly. Obviously, it's a scale play as far as making needles and syringes, and Becton Dickinson does that very well. And that's the kind of company that we think can continue to thrive in an environment where there's still a lot of uncertainty around what's going to happen with the Affordable Care Act and how that's going to potentially be changed or unraveled or replaced. You need to find places, and what we look for are companies that can survive and thrive regardless of what might be changing within the regulatory environment.
Eric, at this point then, as you put your portfolio together, have you got to kind of ignore who would be the tax winner, tax loser, the reflation trade story, and try and look at the sectors that are going to give you that longer term trend? And the pushback against that, how patient do you need to be when you see stocks hitting all-time highs elsewhere and the financials outperforming?
Well, I think the thing right now, as far as being patient, is really understanding what it is that you own and why you own it. And that's very much how we build our portfolio of 27 companies is, you know, right now is a time where we've seen obviously highs in the market every single day for the last 9 or so, and things are starting to feel a little unsustainable. Complacency is high, volatility is low. This would be a time where we want to manage risk, and the way that we manage risk is really about making sure that the companies that we own are on sound, fundamental financial footing so that they can continue to produce a business return that's attractive regardless of what might be happening in markets and the economy. And then what we need to do is also make sure we're paying attention to how much we're paying for those. And we can still find opportunities even in a market where it continues to feel like it's hitting highs every single day. But you have to do a little more due diligence these days than perhaps just investing sort of indiscriminately because you fear that you're missing out on what's going on in the markets.
So Eric, you at Jensen take a longer term view, as you've described. You've got 27 companies, they're going to be a sound financial footing. Do you take into account at all the increased, if I can call it, policy volatility with the Trump administration? It will change the environment in which those 27 companies operate. Some will do better, some will do worse. Do you take that into account?
Yeah, we do absolutely take that into account. It's part of the overall consideration for all of our businesses is what's happening from a policy perspective. And the unfortunate thing right now is, and I think the difficulty for a lot of investors is that we are in a still very much a rhetoric phase rather than a reality phase in terms of what those policies are going to actually look like. We do take that into consideration. We have to be, you know, cautious where there might be regulatory issues that could harm our businesses. You know, whether it's some of the immigration issues around, and particularly around the H-1B visas, that could harm some of the outsourcing companies that might be participating from a tech perspective. We have to take that into consideration. But ultimately, if the franchise or the business is strong, they should have the ability, at least that's in our assessment, to overcome that. It'll just be how we manage that risk within the portfolio and how we position the companies that will make the difference as to whether or not we want to hold on to them for the long term.
So Eric, we got your layout of how you wind up evaluating stock on a micro level. In one word, what's your favorite pick right now?
Our favorite pick right now is PepsiCo.